So what we did yesterday was we looked at several things. The first thing we did is we looked at these basic elements of what we call a crediting formula. We looked at what a crediting period is, which is just how often interest is calculated and credited. That can be 1 year, 2 years, multiple years, again, the most common being 1 year. We looked at how these spreads, participation rates, and caps work, and we understood that really what they're for is to limit potential credited interest relative to what the potential increase in the index would be. Again, can't limit downside without limiting upside. So we learned what the participation rate is. We learned how that works, what caps and spreads are, and kind of the difference between those two, and what makes caps and spreads either go up or down over time. Then we looked at how the most commonly used and the original type of indexed interest strategy was the annual point-to-point with an annual cap, or that could also be tied to a spread or just a straight participation rate. So we looked at how the math works on those and did the same thing for what's called the annual monthly average strategy. So today we're going to move on right now to the next most common one, which is called an annual monthly cap strategy. Now, this couple things about this strategy. You may recall yesterday when we looked at the annual point-to-point with cap, and then we looked at the annual monthly average, and one of the things I mentioned on that strategy, that annual monthly average, was that the reason it was developed was so you could capture what was happening between point A and point B on the index, assuming that it went up, okay? Well, this annual monthly cap strategy, which is technically called an additive strategy, which we'll talk about why that is another attempt to be able to capture what's happening on the index, but in all those different months between point A and point B. This particular strategy gives the highest potential interest crediting of any of the index strategies. But as we're going to see as we go through this, it also has a potential flaw in it, okay? So let's talk about the annual monthly cap. And by the way, I really like this strategy, okay? So looking at this, what is the annual monthly cap? Well, once again, this made-up market scenario we see on our screen we're going to use to keep consistency between the other ones that we looked at. So with this one, this works really differently than either the monthly average or the annual point-to-point. In this case, we're actually going to measure the percentage change every month in the index, and we're going to subject that monthly percentage change to a monthly cap. Thus the name of the strategy. Then at the end of the crediting period, in order to determine how interest is going to be credited or how much is going to, we're simply going to add all the monthly gains and losses together. That's why it's technically called an additive strategy. And by the way, this particular strategy most closely resembles what it's like to have your money actually in the market. And you'll see why that is here, as we go through this. So let's take a look at this thing. Now let's assume that we have a 2% monthly cap in effect on this. So what that means is when we measure these monthly gains every month, the monthly gain that's going to be eligible for crediting is going to cap out at 2%. So let's just look at a strategy here. So we see in month 1, the index went up 1%. Month 2, it went up 1.49. Month 3, it went up 2. Month 4 and 5, it was negative. Months 6, 7, and 8, it keeps going up by, whatever it's going up at. Month 10, it goes back down, and month 11 and 12, it goes up. Now, when we look at these monthly caps, anytime we see a 2%, because that's the amount of our cap right here, that means that the index went up 2% or more in that given month. We go to our spreadsheet comparison, we'll see that, okay? So let's do the math on this thing, okay? The math is really simple. What we're going to do is we're simply going to add negatives together. So we're going to have 12 positives and 12 positive and negative numbers, in this case mostly positive because of this particular scenario. And then whatever those come out to is our interest crediting. So in this particular market scenario, which again is made up, if we had a 2% cap in the index, whether it's the S&P or whatever, actually perform this way, then there would be an 8.32% interest credit to the account value at the end of the, at the end of the crediting period. So when we first look at this, this looks really strong. Vitaly, what do you think of this one?
Yeah, I mean, the math, this particular scenario, I mean, the math is great. I mean, 8%.
The math is simple. And when we're actually doing those adds down there, look at, for example, right here, we go plus 2%, and if we were doing this on a hand calculator, we go plus minus 1.43. Okay, so that's what's happening. We're simply adding these monthly results up over time, or over 12 months if it's a 1 year. If it's a 2-year strategy, there'd be 24 of these things, okay, subject to whatever that monthly cap is. Well, when this strategy first came out, it was really heralded and it was marketed a little bit deceptively. And I'm going to show you why that is. So if we have a 2% monthly cap, then 2 times 12 is what? 24%, right? And this type of strategy was marketed as you have a 24% gain potential here with no downside risk. And that's actually technically true. If the index gained 2% every month and never went backwards, okay, this strategy would produce a 24% gain with a 2% monthly cap. When these things first came out, I think the caps were at 3, and that's how agents were marketing this. Look, you can make as much as 36% with no downside risk. And technically that's true. Of course, it's never happened in history, but technically that's true. What else I like about this strategy is it's also fairly simple. It's a pretty simple one to explain, wouldn't you think? Okay, we're not doing any of this begin value, end value, averaging, any of this kind of stuff, and then apply to a cap. We're simply saying we're going to measure what the index does every month, and up to whatever that cap is, in this case 2%, that gets eligible for crediting. Here's the Achilles heel of this strategy. Monthly losses are not capped. So monthly gains are capped, but monthly losses are not. So what this means is if we get a big monthly loss, it can wipe out everything else. Does that make sense to you?
Right.
Oh yeah, yeah.
Okay, now let's look at our spreadsheet. So let me hide these ones. And I'll blow this up a bit for you. So this is the scenario we just looked at. In fact, this is why on this side of this thing I have beginning and end monthly values. Okay, because remember, when we were looking at annual point to point, and we were looking at averaging, we really didn't care about that. We just cared about the beginning, and you know what I'm saying? Okay, that's why this is on this spreadsheet. So I want you to notice something here. We have a 2% month. So for example, right here, the index gained 2.44%, but that's more than the cap, so we cap out. Now, this particular scenario, remember, I just made this one up, doesn't have any really large monthly losses. We got 1.39, we got half a point there. And that's why the gross index result, if we add all these numbers together, uncapped was 9.67. But with our capped, it would be 8.32. Still spectacular, wouldn't you agree?
Yeah.
Okay, now let me show you a real. But now let me show a real scenario on this. And we're going to go back to what happened the last 12 months. Now, last negatives, minus 175, minus 5%. And you notice, if we have a gain, okay, it's capped at 2. For example, see this gain here of that month? We get 2 of it. But look at this negative 5% loss. We take the whole loss. So last 12 months, because the index was so volatile, okay, we get nothing. See that?
Yeah.
In other words, those negatives were enough to wipe out any of the positives, okay? And that's the thing about a strategy like this, okay, is that you've got to be careful with it, okay? Now remember I said yesterday that in a rising market, just about any strategy is going to do well. At least it's going to cap out or it's going to do pretty well. So when we know that we're going to have, or we believe we're going to have fairly stable markets, say over the course of the next year, in other words, I tell you where a strategy like this would have just killed, would be, again, from March of 2009, okay, for the most part up until, you know, the end of 2015 or 2014, this thing would have just rocked because we had basically a market going up all the time. Does that make sense to you? Now I want to illustrate that to you by going to something else, because this stuff is important that you understand. I'm going to go to a different spreadsheet here. I have lots of these things. Okay, we're going to go to this. And all I want to go to is my SPX master here. I have S&P 500 numbers on a monthly, quarterly, and annual basis going back to the 50s, guys, okay? But what I want you to note in column here, and this shows us our monthly point-to-point results. So for example, in 2006, we have a negative there, had 1 month that was negative. So a strategy like this would have just killed. You see that? Okay. 2007, we got 1, 2, 3, 4, 5, some pretty big negatives. So this strategy would probably produce 0 in 2007. Okay, could have been. I mean, the annual point-to-point on that point was 3.53. So could have gone either way. Okay. In fact, let's just see. I'm curious. Let's look at what would have happened in 2007 with this. If you guys don't mind playing with it. It's not going to do. I got a formula, and I knew that wouldn't work. Why did I do that? Okay. Anyhow, all right.
I'm sure it wouldn't have done well.
If we look at 2008, -6, -3.4, 3 negative months in a row. That's 10% negative in the first 3 months. -8, negative. See what I'm getting at? This type of strategy would have just suffered horribly, but anything would have. The index lost 38% that year. But if we go, could have been either way, even though it gained 23%. Look at -8, -10. We have some pretty big gains, but again, those gains are going to be capped.
Right.
And so this is what you've really got to be careful of when you look at these things, because it can look really good on the surface, okay, until you understand that when we look at what monthly losses can look like in the S&P 500, there's -3, -174, look, 6% right there, followed by 2. Okay, that's a 9% loss in 2 months. So if we're capping that upside per month at, say, 2%, but we're not capping the downsides, okay, that's where you've got to be careful about and understand the downside to this strategy, okay? And that's what happened, or can happen, and has happened to agents who are promoting it, because even if we had a scenario, okay, where, you know, let's say we had 2% there, 2%, oops, say we're using a 2% cap, okay? And then let's just say we cap out all the time for the most part. We'll give a 1.5 here, and then we give a -5 and a -6, and we cap out again. Got me? With me? If we add all these up, yeah, we still got 8.5, so not okay. Those minuses were still. You see, I'm getting it, but if you know, if this one goes to 1, okay, and this one was actually -2. See, I'm getting at. Does it take much to take it way down? You see what I'm getting at?
Right.
Yes.
Okay. So I really like the monthly cap strategy, okay, but you've got to be careful. Now here what the index actually did for this time period, a year, is only 2.68 anyway, if we add up without caps here. So it was a bad year in the market, okay? So it wouldn't be unreasonable to get something like that. And my point simply is this, is sometimes you can have a point-to-point from point A to B that maybe does 5 or 6%, but somewhere in the middle there, we got a big monthly loss, maybe 2, and it can really wipe out the whole thing. And when the strategy was first introduced, the carriers weren't real. I mean, it wasn't that they lied about it, they just really didn't point out to people that, 1 month. Some people like myself saw it instantly, okay? So one of the ways that you use this strategy is usually, from a prudent standpoint, is to use it in combination with another one to try to get what we call alpha. Are you guys familiar with the term alpha in investing?
Right.
Okay, Vitaly, you're about to be, because you're about to get a 65. What alpha means is extra yield, beyond, a little extra earnings beyond what just the normal market does. So if the normal market does 5%, and an easier way to think about this, and we earn 6%, well, we got alpha on that 1%. That's the term, and it's just a term that's commonly used, okay? Well, it's really not a term you would normally use in fixed annuities because they're not investments, but the way you can use the annual monthly cap strategy fairly effectively while at the same time limiting its potential downside is, remember, we can allocate money into different strategies within the same contract. So maybe we would put 60 or 75% in something like the annual point-to-point with cap, okay? And that other 25% we might put in this annual monthly cap, because if it does really well, the total aggregate interest on the total, you know what I'm saying, on the total account value could be better than if we just went with the cap. But if we get a really negative month, it's not enough to wipe out everything. So that's how, and that's why these contracts have these multiple strategies, so that you're not putting all your eggs into one basket, or your clients. See what I'm getting at? So this is the thing. So when you first look at this, I'll never forget the ads that came out when this was introduced. 36% potential with no loss. And you know what your average agent was telling the clients. Look at this. And then one bad month, one really bad month, kaboom, and wipes out everything. And then you have these clients again who are saying, now wait a minute, the S&P did, I don't know, 10% last year and I got nothing. Okay, well, it only took 1, maybe 2 bad months, and the rest of them could have been positive. So again, we're not doing investing here, but it's really important to understand that. So you guys clear on how this one works?
Yes.
Yeah.
Okay, now, why did I use a 2% monthly cap? Well, that's one that's currently available right now. If I'm looking back on, again, this Global Atlantic sheet, and I used it, oh, excuse me, actually it's at 1.9, okay? Somewhere in there at 2, somewhere at that, and here's one at 1.4, and let's see, the monthly cap, let's see what else it is.
Can the caps differ month to month?
No, they're good for the length of the crediting period. Okay. Now they can drop them, or well, they're not really going to increase, but they can drop them at the annual renewal. Here's the thing to remember also when we look at these strategies. So again, I'm looking at a Global Atlantic. That's fourth current rate sheet, and these, as with all of these rates, whether it's an annual cap, a spread, a monthly cap, they're going to vary these by the product. So for example, looking at the current rate sheet here, if we look at the Choice Income, which is a product I really like for income benefits, their current monthly cap, okay, is 1.9 on the Choice Income, okay? If you go to the Choice Accumulation, okay, it's only 1.4, okay? If you look at the Four Freedom Savers product, it's 1.3. And that's on the ultra band. If we look at the Four Spending Select, it's 1.3. The Four Spending Select with bonus, for some reason, it's 1.4. We would normally expect a bonus product to have lower rates, okay? And then the Income 150 Plus, it's at 1.4. So the reason these strategy rates will vary from the same company, okay, but on different product lines has to do with other elements of that product. I was a little surprised there because with almost without fail, anytime we have an annuity issued by, say, company ABC, and they have two products, one with a bonus and one without a premium bonus, almost without exception, the rates offered on the bonus product will be pretty significantly lower than the rates offered on the bonus product, okay? I mean on the non-bonus product, excuse me. That's almost without exception here. I just saw an exception, but there must be something else in that product that is doing something there, okay? So that's another thing to always remember, and that's why if you look at marketing material and disclosures and things like that, if you're using an annuity that has like a big upfront premium bonus, it's required to put on there. Premium bonus may result in lower crediting rates, okay? And so that's also something to always remember about premium bonuses. That's a different conversation and a different set of training on bonuses versus non-bonuses, but you will almost without exception find that to be true, okay? And part of the reason for that, if not the entirety of the reason for that, is because a carrier with its investment strategy in bonds can only offer a client in a given interest rate environment X amount of total gain over time, over 10 years or whatever it is, okay? So when they're giving a premium bonus, typically what they're doing is they're just front-loading some of that potential gain over that 10 years, and therefore the crediting rates tend to go down. And so again, it's not necessarily a bad thing. There's often times when we want to use premium bonuses, okay, as long as the client understands that a non-bonus product might give them, and usually will give them, higher potential crediting rates. So it's really bird in hand versus two in the bush is an argument that could be made on that particular issue. So, we clear so far on this stuff, guys?
Yes, I am.
Okay, so that's the annual monthly cap. I really like it. My two favorite strategies are the annual point-to-point with an annual cap and the annual monthly cap, sometimes called a monthly point-to-point with cap. You know, these little slightly different names, different carriers use for these, okay? Now I'm next going to show you a strategy that is my favorite for older folks, okay, because it is so damn simple. Unfortunately, there's not a lot of carriers that offer it, okay? It's called an annual performance trigger strategy, okay? Same scenario here. Now, with an annual performance trigger strategy, similar to a point-to-point, we're only going to measure the index twice. Our starting value, point A, point B. We don't care what, so we're going to look at it. So in this case, we have, just like in all of our examples, and our ending value is 1100, okay? So pretty simple measurement. What's beautiful about this, and the reason I say I like it for much older clients, is there's no math, okay? There is no math to an annual performance trigger strategy. It's simply a set rate of interest. Let's assume it's 4%, what we call a trigger rate. And to determine annual interest crediting is a simple question. Did the index go up or stay the same? Yes or no? If the answer is yes, then they credit that interest rate. If the answer is no, then there's nothing. That's it, okay? So for example, we started out at 1,000. If this point B was 1,000, the same, they would get 4% interest or whatever the trigger rate was. If it went up by 0.1%, they would get that trigger rate interest. But if it didn't go up at all, then they get nothing. It's about as simple as you can get. I love this strategy with a couple of exceptions, okay? It depends upon what the trigger rate is. So the way I look at that personally, and different people and pros have different legitimate views on this, is I compare the trigger rate to the annual point-to-point cap rate. And if it's close to that annual point-to-point cap, okay, then I'm going to use the trigger rate instead of the cap, because all the market has to do is go up, and you're going to get, you know, whatever that published rate is. If that rate is significantly lower than the annual point-to-point cap, well, then you got to think about it, okay? But if we're dealing with clients who are much older, well into their 70s, really don't want complexity, okay, I love this strategy because it's real simple to explain it to them. If the S&P 500 goes up at all, or just stays level at the end of the year, you get 4%. If it has dropped, you get nothing. Pretty simple. In any event, you can't lose. What do you think of this?
Yeah, that makes sense.
Yeah, that one is for most. I get it for the older people, definitely.
Oh yeah, I love it. And I love this strategy. The problem is there's very few carriers that offer it. When Genworth was still doing annuities, okay, they had the best trigger rate I've ever seen. If for example, they had an annual point-to-point, I'm remembering this off the top of my head, let's say that annual point-to-point might have been at, you know, 4.5, their trigger rates were somewhere around 4. Okay, and so it was an easy one. Okay, well, they're out of the annuity business, unfortunately. Not because their annuities weren't great. They had some of the best products on the market. It was their LTC business that killed that off. And so if you ask me right off the top of my head right now, who's got a trigger rate out there? I'm sure the Standard still does, but that's a company not a lot of people use. I love the Standard. And I'm not even sure. Most of our big, well-known ones, American Equity, Forethought, I don't think Athene has a trigger rate, but they might on one of their products. You just don't see it on too many places.
No,
But,
I haven't seen, that's why, yeah, I hadn't seen this. That's interesting.
Yeah. And so like the Standard has had it forever, okay? I think for all I know they invented it. Some carriers occasionally have come up with trigger rates that are downside based. They work the opposite. Basically a bear strategy, okay? If the market goes down, you get the rate. If it goes up, you don't. But, you know, there's not too many. You don't see too much of that. But it's so damn simple. And it just depends upon what the rate is whether, you know, it is worth taking the chance on it. But one of the things that we need to do, in my view, is we need to find who's currently offering trigger rates. I know I've seen them on products in the last year other than Genworth. I just cannot remember who they were at this point. So it's a little research that we want to do. And so again, if the rate looks pretty good, because it's not a sure thing, the market might go down, okay? But if you're looking at, you know, a market that might go up 2 or 3%, you have a 4.5% annual cap, okay? And you can say, look, if this goes up at all, you get this 4% interest, or, you know, whatever it is. It's a really simple strategy. I love it. So we don't even need to look at a spreadsheet for an annual performance trigger, okay? It is what it is, okay? The only thing I'll tell you is if we go back to this spreadsheet we were looking at for our comparison, that this index, hang on, let's look at our annual point-to-point. Let me unhide these. Okay, our annual point-to-point went up 2.225% in this, you know, last 12 month scenario. Okay, if we had a 3 or a 4% trigger rate in effect, they would have gotten more. You see what I'm getting at? And so it can be a pretty good thing. It can be a pretty good thing. And so anyhow, hope that's of value to you. Any questions on that? Or on the additive?
I'm okay.
Okay, good. Now then what I'm going to go ahead and move into now, because we have time, is we're going to talk about indexes. Okay. This is the other component of index strategies, is the index that's used, okay? We talked a little bit about that yesterday, but it's important to really understand what indexes are. For 2 reasons. One is pros, we need to know what they are, but you're going to find that if you ask the vast majority of consumers, and they've heard of the Dow Jones and they've heard of the S&P, and you say, what actually is that? They don't have a clue, okay? And one of the things that is powerful about indexes is what they are and what they're not. So let's actually take a look at that, okay? So as we know, there's all all these indexes, and they're very commonly a lot of financial tools-based returns upon them, not just annuities that are indexed, not just life insurance indexed, but index funds. We've all heard of, index funds and index ETFs and all of that, where they're using these same exact indexes or close to it anyway. The index funds work slightly different, but don't worry about that now. So the first thing we want to understand is what actually is a stock market index. Well, it's simply the grouping of the stocks of a bunch of different companies that are artificially grouped for measuring the overall performance. In other words, a stock index doesn't really exist other than it's this kind of artificial idea, okay? That's why if you ever read some of the fine print on some of this annuity material or other things like that, it says, we're tracking to the S&P 500 composite stock price index, which you can't actually invest in the index. That's because these are just conceptual things, okay? So an index is named after the stock exchange, the publication, the company, or it could even be an individual that tracks the performance of that index. So for example, the Dow Jones Industrial Average, or the Dow, arguably the best known one, well, that was originally created by the Dow Jones Company, okay? And it was the original market index was created by the Dow Jones Company. What we call the S&P 500, its actual name is the Standard & Poor's 500 Composite Stock Price Index, okay? Standard & Poor's Company invented that index and tracks its price. NASDAQ is all the stocks traded on the NASDAQ exchange. That's an interesting one. I'm going to tell you a little bit more about that in a few minutes. Then you've got all these other different ones. Russell 2000. The Russell 2000 is invented by and tracked by a company called Russell Investments. So my point is simply this. Anybody can invent an index. There's thousands of them out there, okay? To track anything that you want. I used to make a joke to agents and consumers if I could create an index based upon the rise and fall of the insurance company president's checkbook, okay? Meaning, if I can set up some rules and I can quantify the change, percentage change up or down every day on that, I could theoretically create an index on it. That's all an index is. So anybody can create one of these things if they're willing to, go through the issue on it. Now, the thing about the component, actually let me go back to here for a moment. Now, these indexes work very differently, okay? And they're all tracked a little bit differently, and we'll talk about the differences. And I'll go ahead and tell you about the NASDAQ now because and the Dow Jones. Now the Dow Jones is the most well-known, but it's only 30 companies. So how did the Dow Jones Industrial Average become this kind of, it's really not even considered a benchmark anymore that much, but one that's talked about so much? It's only 30 companies, okay? Well, first, it was the first one that was ever done, but secondly, because at the time and for a lot of its lifespan, okay, the Dow Jones Company also owned a small publication that was called the Wall Street Journal, okay, which is the preeminent newspaper for Wall Street. So they were able to use the power or the publishing power of the Wall Street Journal to make this Dow Jones average into something everybody pays any attention to, okay? So that's part one of what I call useless cocktail party trivia, okay? The NASDAQ's even more interesting. I mean, what the hell does this mean, NASDAQ? You ever wonder about that, Lori? Where does that come from?
Yeah, wild name.
Okay, I'm about to tell you. National Association of Securities Dealers Automated Quotation System. In other words, when the NASDAQ started being talked about, it was not a stock exchange. It is now. The NASDAQ is a stock exchange now, okay? But the NASDAQ, when it really started being paid attention to, was simply the original computerized stock trading system that was developed on Wall Street, okay? What we now call FINRA used to be called the National Association of Securities Dealers, or the NASD. And the NASD changed its name to FINRA, I don't know, in probably 10 years now, okay? but it used to be called the NASD. So how did that thing, why would people talk about that? Okay, it was just a computerized trading system. Because of the dot-com bubble back in the mid to late 90s. When those companies in the mid to late 90s started creating these small publicly traded companies, and they had these really strange names like Yahoo and Google and stuff like that. When those companies were formed and went public, they were not large enough companies to be listed and traded on the New York Stock Exchange. You have to be big enough to do that. And they were what were called over-the-counter stocks, okay? And over-the-counter stocks were traded on these smaller exchanges, and the only tracking on them was trading system, okay, that was called the NASDAQ at the time. So journalists started watching what was happening on that because these companies were taking off, and so everybody started talking about this thing called the NASDAQ, okay? Prior to probably 1994, nobody other than people on Wall Street, they even heard the damn thing existed, okay? And it eventually converted itself into a full-blown stock exchange, okay, because of the publicity, but it all started simply because of that dot-com tech boom in the mid to the late 90s. Another interesting piece of trivia about the NASDAQ, you ever heard of this guy called, he was a fraud guy called Bernie Madoff? Ring a bell with you?
Oh, yes.
One of the ways Bernie Madoff made some of his original and legitimate money on Wall Street and his original reputation was he helped develop that NASDAQ computerized trading system. So, enough trivia. Okay. Now here's the thing that most people are not aware of, which is both good and bad depending upon what you're talking about. What we call the component stocks in the index, the stocks that are put together and represented on that index are changed periodically. They are not consistent over time. Okay. This is the S&P 500 index from 2004 to 2014. Why that? Because I haven't updated this chart since 2014. Okay, all right. My point is this, when we look at the movement of this index over that 10-year period, the stocks that were being calculated as part of the S&P 500 here in 2007 are not the same ones here in 2014. Some are, but some are different, okay? This is the changes in the S&P 500 index in 1 year, from July of 2013 to July 2014. And so what we're seeing is they're constantly pulling stocks off the index and putting other ones on. So we can just pick a spot here. Right here, Michael Kors was put on the index and they took off the New York Stock Exchange. Here, something called Tractor Supply replaced something called Life Tech. Under Armour replaces Beam Incorporated, whatever the hell that was, okay? Martin Marietta replaces U.S. Steel. See what I'm getting at here? Your average person out there has absolutely no idea this is going on. Now, each index, the way that works, they don't just necessarily do this willy-nilly, okay? Each index, when it's established, has different rules for what types of stocks are going to be on that index, okay? And so why would a company be taken off an index and replaced with another? Well, there could be a variety of reasons. It could be because their stock fell so far down that they're no longer big enough to be represented on the index. So that's an example of saying, let's get that dog stock off the index and get something better on there so the index looks better. It could be because of a major shift or a change in industry. So here's an example of that. Here in whatever year this was, close to January of 2014, there used to be a company called Teradyne. Facebook replaced it. Well, that's to represent what's really happening in business, I guess, or something like that. But the S&P 500 index is constantly pulling companies off and putting them on. Other indexes do it differently. The Dow Jones makes changes, but not nearly as frequently as the S&P 500. Then you have indexes like the Russell 2000 Small Cap Index that only does it once a year. okay? And they make all their changes once a year. But my point is simply this, okay? Oops, excuse me. This is good if they get the dogs off and put better stuff on these indexes. If your earnings, whether that's stock-based earnings or whether that's interest earnings, are dependent upon that index going up. Where this is a bit, if not completely deceptive to people and to investors, is that one of the common things that stockbrokers have done forever is when somebody is starting to learn about investing, they pull out these charts. They're called Ibbotson charts, and you guys have all seen these, okay? They start back like in 1929, and they show the Dow Jones and the S&P and yada yada, you know, over time, constantly going up. You guys know what I'm talking about?
Yes.
Yes.
Okay, we call them Ibbotson charts because they're made by a company called Ibbotson. Well, what that chart doesn't tell you, okay, is that if you go back to 1929 or 1952 when the S&P, for example, was established, that if the same companies were on that index as when at any of those points in time, that thing would be so far in the red, it wouldn't fit on the page, okay? They don't tell you that the reason that these indexes keep going up like this, okay, is because there's a fairly constant activity, especially over that long time, of removing companies from the index and putting a different one on. If they were the same original ones, they would all be deeply negative over time, okay? And so this is a good thing if we want our earnings or our interest to be dependent upon these indexes going up. It's a very bad thing if we're saying, oh yeah, well this proves that I can buy stocks and they'll always go up, because that's deceptive. So that's an interesting thing to lay on a consumer when you're talking about this stuff. Is different, and they're typically intended to reflect something, either the broad market, a sector of an industries, or maybe a size of company. So broad index, okay? Broad indexes reflect the market as a whole, okay, or some big chunk of it, versus sector indexes reflect a specific industry or maybe a company size. So for example, the S&P 500 is the benchmark U.S. broad index. It's stocks of 500 big companies, what we call large cap companies, and all the different sectors are broadly represented on the S&P 500. Their goal there on the S&P 500 from a management perspective is to always represent at least 75% of the total market capitalization of the U.S. stock market. The Dow Jones Industrial Average is also considered a broad market index, but there's really only 30 companies on it. The NASDAQ Composite Index is a broad index because it pretty much represents everything traded on the NASDAQ exchange. When we talk about sector indexes, okay, here's some examples. The Russell 2000 Small Cap Index is a sector index, meaning it's only looking at small capitalized companies. It doesn't have the great big companies on it. Now, small is relative term, guys. Let's remember that, okay? Or the Dow Jones 15 utility, because there are 15 big utility companies that's tracking that. So other types of indexes are what we talked about yesterday that can be a little deceptive if you don't know what you're looking at. Remember I was talking about these indexes where they're volatility controlled, okay? Mm-hmm. So you can have an S&P 500 volatility controlled index, so it's a subset of the S&P. It's not the same thing. It's not going to perform the same way. So again, as we mentioned, that's 500 large corporations. The Dow is 30. The NASDAQ's about 3,000. It's actually getting a little bit lower than that because there's barely 3,000 even publicly traded stocks left in the United States markets anymore. One of the things that we've seen in the last probably 10 years is total number of available traded stocks is almost been cut in half. It's one of the other reasons the markets have gone up, is because there's less availability. I could show you a chart on that that's kind of interesting if you want to see it. Here's the point that I really want to get to. When we look at these broad market indexes like the S&P 500, the Dow, and the NASDAQ, their movements, especially over time, tend to parallel each other. So this blue line is the NASDAQ, this black line is the S&P 500, and this kind of brownish line is the Dow Jones. You'll notice that in any given point in time, one may go up more than the other or something like that, but parallel to each other. As a general rule, when this, the NASDAQ goes down, so does the S&P, so does the Dow Jones, and when, they go up, they tend to do the same thing. Now, the point of this, to me, is understanding this parallel movement. First, we have to understand why that happens. Well, there's a couple reasons it happens. One of the major reasons it happens is because some of the same companies are on every index. For example, virtually every stock that's represented on the Dow Jones Industrial Average is also on the S&P 500, okay? Certain stocks that are on the NASDAQ are also on the Dow. Good examples of that are Facebook. Facebook is traded on the NASDAQ exchange, but it's also a component of the Dow Jones Industrial Average. So there's a good example there. Facebook is also on the S&P 500. So as these indexes are tracking the cumulative up or down of all these different stocks. And so if you have the same stocks represented on multiple indexes, they're going to parallel each other largely when they move. Now I'm going to get to a point for consumers here in a moment. The other reason they tend to parallel each other is because of mutual funds. So what do mutual funds do? They go out and they buy a bunch of stocks of a bunch of different companies, okay? So as these mutual funds are buying and selling these stocks of these different companies that are represented on these indexes, again, we have a lot of overlap there. So that's one of the reasons that they parallel. The third reason they parallel each other over time and movement is simply because they're broad market sectors and they reflect the overall opinion of whether the market should go up or down of what we call the large institutional investors who run the markets. Here's the real point. While one index or the other in a given year or month might go up or way more down than another one, okay, since they're paralleling each other over time, and from an indexed annuity or an indexed life standpoint, it won't always make that big difference what index you're using, because if one goes up, the other is going to go up, and if one goes down, the other one is likely to go down as well, okay? The reason this matters is because one of the marketing things that carriers try to do is to try to make you believe that one index is going to broadly outperform another, especially when we're talking these broad indexes. So for example, when FIAs first came out, equity indexed annuities, they were all on the S&P 500, okay? And then I remember, I don't know, late 90s, mid-late 90s, American Equity was the first, I believe, to tie a indexed annuity to the Dow Jones. And I remember the marketing. Holy cow, it's the Dow. This was the marketing was being sent to all the agents. Holy cow, we got the Dow, okay? But the performance wasn't really going to be fundamentally different, especially when we understand how they set these caps and all of that stuff. So it was a pure kind of marketing thing to make it look like maybe something better was going to happen as a result of it, when in fact it really didn't. You guys, am I making sense to you guys?
Yeah.
Okay, so stock market indexes, their change is measured in points. Now, the first thing we have to understand is that points are completely meaningless to the average consumer. Every index assigns a different point level, and how those points change relative to stock prices. Every single one of them does it differently, and they do different what we call weighting. So let's look at an example, okay? Oh, also, those point values of different indexes have absolutely no relationship to each other. Let's look at a point in time here, okay? So, July 9th, 2014, okay? The blue line's the NASDAQ, the black line is the S&P 500, and the Dow is that brownish line. Let's look at what happened on this day. The NASDAQ ended up with a 4,419 point value, which was a 27.57% gain, okay? That same day, the S&P 500 gained 9.12 points. And that same day, Dow Jones gained 78, call it 79 points, okay? But what matters is the percentage gain or loss. So what we see there is that, especially the S&P and the Dow in this particular day, point gain or their percentage gain or loss was almost identical, 0.46 versus 0.47. But the point values were wildly different. In other words, on that day and time, a 9-point gain in the S&P 500 equated to the same percentage gain as a 79-point gain on the Dow. Now, the reason this matters, especially to us as pros, but it's always interesting things to point out to consumers, is for reasons that are not entirely clear to me. The mainstream media like CNN and all that, they always report the point gains. I think it's because it sounds better, okay? So think about when you watch the news on CNN and they'll go, oh, okay, well the Dow gained or lost 200 points. 200 point up or down on the Dow Jones is about 1%, okay? They make it sound like it's this big deal. Oh my God, the Dow lost 150 points today, okay? It's less than 1%. Okay, so see where I'm coming from? Okay. They don't report the percentage gain or loss. I don't know why. I think it just sounds better. It's the only thing I can come up with, because to your average person who owns mutual funds and stocks and doesn't know this stuff, they hear that, it means absolutely nothing to them. If instead they said the S&P gained 0.5 point or 0.5%, at least it would mean something to them. Now, there's other types we have bond indexes that work the same way. There's real estate indexes, okay? There's these things that become very popular now in some of the indexed annuities where they're combining some bonds and some stocks. And they'll throw gold in there and various other things. You can create anything you want, and you can create caps and spreads and all that for anything you want, as long as there's somebody out there in the financial world willing to take the bet. In other words, he'll sell you an option on whether or not that thing is going to go up or down. And so that's why I go back and I can say I can create any kind of index I want. Whether or not anybody's going to pay attention to it is whether or not I can get it noticed. And this is the thing, okay? The insurance companies have to pay these companies that own these indices and track them for the right to use them and put them on their materials. So the most commonly used, you see it on almost every offering, is the S&P 500. Well, why is that? Well, it's because the S&P 500 is the benchmark index for the broad U.S. stock market, okay? It's the thing that we compare everything to. And there's a price that every carrier, Global Atlantic, American Equity, whoever, pays annually to the people that own S&P 500, which I think is now McGraw-Hill Publishing, but I can't remember if it's changed again, okay, in order to use that name and track their index. One of the reasons it took a while for anybody to tie to the Dow Jones Industrial Average is because Dow Jones charges more for that than the S&P 500 does, okay? You see where I'm coming from? So there's a lot of different things behind the scenes that can come into play on all this. From our perspective of understanding life insurance and annuities that are indexed, we just have to understand what these basic indexes are. And as a general rule, it's usually a good idea to stick to the broad indexes. Why? Well, let's go back to this Global Atlantic. I'm only picking on them because I printed out their rate sheet. So one of the things that Global Atlantic really pushes, and I'm not saying it's bad, it's just different, okay, is the BlackRock Diversa Volatility Control 2-year point-to-point with spread index strategy, okay? Now that could be a great index. I can tell you it has bonds in it and some stocks in it and God knows what else, okay, all right? But your average consumer, much less you, cannot look up publicly what that index performed like today or last month. Usually you can, on these oddball things, you can only find their performance if you own what's called a Bloomberg terminal. And you know, anybody can own a Bloomberg terminal if they want to pay $35,000 a year for the privilege of having it, okay? Versus, that's true, okay? Versus, I'm going to bring something over here on the screen, okay? These public indexes, okay, bringing up a site here, hang on a minute, okay, that we see what they're doing constantly. Okay, you know what I'm saying? Anybody can see what's happening with most of these indexes. Okay, I can go in here on any number of sites. So I'll go to the S&P 500. I see what it's doing. I enter the symbol. Come on, clear. Okay, that's the symbol for the Russell 2000 RUT. Eventually going to show me if my internet wants to key. There's the Russell 2000. I can see what it's doing today. It's not doing very well today. It's lost 1.09. What's it done in the last 3 months? What's it done in the last year? What's it done in the last 5 years? So in other words, it's very public. There's no way to kind of you know, control that. I can do that for any stock, any mutual fund, anything. But when we get into some of these weird-ass, strange types of different indexes, I'm going to show you an example. I'm going to go to Big Tree. It's a site I use a lot. Hang on just a moment. It's a subset of the Dow Jones. And I'm going to say, I need to find for the BlackRock Diversa. See, I'm getting here, so I'm going to Diversa, what the hell do they call that thing? The BlackRock Diversa Volatility Control. And I hit boom, and I'll be shocked if it comes up. Never has before. We don't know what the hell you're talking about. See this?
Yeah.
We can find something about market volatility. We can find something about this, okay? Versus if I say Microsoft, search thing. You see I'm coming from, guys? And I'm going to get that symbol, you know, right away. Well, I'm on the wrong page now, but you get my point, okay?
Yeah.
Go back to big charts. It's going to come up. So in saying that, I'm not saying that these obscure indexes, that they're doing anything untoward. I'm not saying that at all. I'm simply saying when we talk about this stuff, okay, I like the public, very broad indexes because anybody can look them up. Me as a professional, I can look them up. I can track them and see what, you know, my client's money might be doing, whereas it's more difficult with these other ones. And so again, that's something we have to be aware of, okay? Now with these other ones, these more obscure ones, what I call the made-up indexes, okay, that are created largely for these annuities, and so, hey, they may do great, okay? My problem is I can't track them easily, okay? So that's where that comes down to. So with that, I do believe that's the end of my dog and pony show for today, guys. Yep. Any questions on anything that I've covered?
No, I think I'm good. I mean, those dark stocks, I mean, what are they usually comprised of?
Well, they're not dark. They're just they're what I would call obscure indexes that are sometimes created solely for the purpose of using them on an indexed annuity or life. They could be other ones that are just out there that somebody created, and they can be all kinds of stuff. For example, the Barclays Armor 2 Volatility Control strategy, okay, is what they call an actively managed strategy where they're constantly looking at 6 different asset classes, from stocks to bonds to gold to, I don't know what all is on it, okay, don't remember anyway, and they're always trying to heavyweight it, whatever did the best the previous month. It hasn't done real well, okay, and sometimes it might do really well. So it could be bonds, it could be stocks, combinations of different things. Hell, there could be cash components in there. They can bring in gold, they can bring in oil, they can bring anything they want. I mean, you can create anything you want, okay? Now, having said that, some of them could do quite well if they're well designed and et cetera, okay? So I'm not saying they're bad. I'm not saying that at all. I'm simply saying you can't publicly track them easily, if at all, okay? The fact that you can't publicly track them at all, at least without a Bloomberg terminal, doesn't mean that they're doing anything on, you know, that is suspect. I don't mean that at all. I just simply mean as the investment and insurance, a financial professional, I'm personally more comfortable with things that my client, if they ever wanted to look it up, can find it. You know what I'm saying? Most don't want to. Something I can track, as I just showed you, I track what the S&P's done on a monthly, quarterly, and annual basis going back to 1950. I always know where it's at,
Mm-hmm.
When I was doing Saturday summary every week, I can tell you exactly where these things are at. And if you're able to do that, so for example, if I know that in the last 12 months, the S&P has gained, 6%, or it's really down to about 3 now, okay? I know if I sold somebody a fixed indexed annuity a year ago that had a 4% cap, I know that they're likely to get 3. You see where I'm coming from? If you have an idea of that, you have a pretty good idea of what's coming, okay, on the annual statements, as opposed to being a surprise for you, And so it just makes it easier to talk to clients and stuff like that, in my opinion. Other people would legitimately disagree with that, just my opinion. Lori, do you have any questions?
No, I think I understand. It's been pretty interesting on this side of it. Yeah.
Okay, good. Well, then what I'm going to do is I'm going to go ahead and stop the recording. So that's the end.